Federal Reserve did nothing on Wednesday, and mortgage rates went up anyway. 3 of the Fed's regional presidents voted against the decision, and all 3 of them wanted interest rates higher. So if you're about to sign a contract on a house, the next 6 weeks decide what your repayments look like in the next 30 years. Here's what actually happened in Wednesday's meeting. The FOMC voted 9-3 to hold interest rates at 3.5 to 3 3/4. It was the 5th meeting in a row with no change. But the bond market did not read that as good news. The 10-year Treasury yield jumped to 4.65%. The 30-year Treasury yield hit 5.2%, and that's the highest it's been since 2007. And when bond yields are up, fixed mortgage rates rise. According to Mortgage Bankers Association, the average contract rate on a 30-year loan is now 6.75%, the highest since August 2025. That's 4 straight weeks of rising mortgage rates as a result of the Fed supposedly doing nothing. Forecasts say it's about to get a lot worse. Markets are pricing between a 72 and 82% chance of a rate hike at the meeting in September. Back in March, not a single Fed official had a hike in their forecast for this year. So today I want to walk you through 4 things. Why a no change decision pushed your mortgage rate up instead of down, who Kevin Walsh is and the damage he's doing, kind of, why American home builders are already behaving like this is over, and how every piece of this lines up almost perfectly with the 18-year real estate cycle. So let's get to it. But before we do anything, let me clear something up. The Federal Reserve does not set your mortgage rate. The 30-year fixed home loan is priced off the 10-year US Treasury bond, plus a spread the lenders add on top for risk. So the Fed can hold, cut, or hike rates, and your mortgage quote still ultimately follows the bond market. Right now, that 10-year sits at 4.65%, and the spread between the 10-year and the average 30-year mortgage is running around 1.9 versus the 1.5 normal rate. So the lenders are charging you an extra 40 basis points due to uncertainty. It's the lenders saying they don't know what happens next, so you pay for it. On a $400,000 loan, the extra bit of nervousness is roughly $100 a month. And that's every month for 30 years. You're probably thinking, why won't the bond market settle down a little? Because inflation hasn't. June CPI came in at 3.5%, which is down from 4.2 in May. So yes, it's improving, but wholesale prices are still running at 5.5%. And there's an input the Fed cannot control at all. The US-Iran conflict has been running since February, and oil has been climbing with it. Oil feeds into freight, into food, into everything the CPI measures. The way it works is conflict in the Middle East lifts the oil price lifts inflation, sticky inflation stops the Fed cutting, and the bond market prices your mortgage higher. That's what we're witnessing right now. According to the National Association of Realtors, the income you now need to qualify for a mortgage on the median priced home is $110,000. The median existing home just hit an all-time high of $440,000. So the average American family is being priced out with a rising rate at the same time. So the obvious question is, who's supposed to fix this? For the 20 years, the answer was the same institution every time, the Fed. Which brings us to the man now running it. Kevin Walsh was confirmed as the 17th Fed Chair on the 13th of May this year. He was a Fed governor from 2006 to 2011, so he was in the building through the last housing crash. And he was nominated by President Trump with a public expectation attached: cut rates and get the economy moving. In his first 2 meetings, he might as well have done the opposite. The Fed held rates twice, and 3 of his colleagues voted to hike. To make things even more unpredictable, Walsh has scrapped forward guidance. Forward guidance is just central bank language for pre-warning the market about what they intend to do next. I mean, what's the point of the meetings? Under the previous chair, you had no idea of what they were doing months ahead, so lenders could price loans around it. Those days are over. He also declined to submit his own dot in the June projections. The chair of the Federal Reserve didn't put his own forecast on the board. So the market is now flying blind from one meeting to the next. And that's exactly why that spread I mentioned is sitting at 1.9% instead of 1.5%. So now let's look at what the Fed committee is forecasting. In the June projection, the median 2026 interest rate forecast rose to 3.8%, which was up from 3.4% in March. Their inflation forecast for the year was also revised up to 3.6% from 2.7%. 9 of the 18 officials now pencil in at least one more hike before the end of the year. In March, that number was 0. That is one of the sharpest hawkish revisions this committee has ever made in one meeting. And there are 3 meetings left this year. September is the next one, and analysts are expecting an interest rate hike. If the Fed hikes into a mortgage market that is already at 1-year highs, the wait for rates to come down plan that most buyers are hoping for will come to an end. And it gets worse when you look at who's building the houses. Every month, America's home builders get surveyed on how they feel about business conditions. Above 50 means most builders are optimistic. Below 50 means most of them are worried. July's reading came in at 34, down 2 points from June. That marked 15 months in a row below 40, the longest stretch of that kind since 2012. When you dive deeper, the buyer traffic component is sitting at 23. Builders are barely seeing anyone walk through the door. This is why 37% of builders cut prices in July. 63% are using incentives. The most common incentive right now is mortgage rate buy down. The builder pays cash up front to knock your interest rate down for a few years. The sticker price on the houses stay high, and in plain English, the builder's margin is getting cut to make the market look better than it is. D.R. Horton, the biggest builder in the country, confirmed this on the 21st of July. They beat on their earnings reports. Then they cut full year revenue guidance. Specifically, closing guidance was slashed by roughly 3,000 homes. The near future is looking average for the US housing market, and Bank of America confirms this too. They noted home builders' earning estimates across the sector have fallen 18% since the start of this year. But it gets a little worse. New home months supply hit 9.3 months. That's among the highest readings we've seen in years. 6 months is roughly a balanced market. Every statistic I'm showing you is pointing towards 2 outcomes. Mortgage rates are increasing and property demand is collapsing. Builders are sitting on more than half again, as much as unsold stock as balance levels, with buyer traffic at 23, cutting prices and paying down your interest rate to move it. That's the opposite of a confident industry. Now, I will admit, I've been fairly one-sided so far. There's a view which suggests I might be early with my negativity. Regions are telling completely different stories. The Northeast was the only region that grew up 2.1%. The South fell 3.6%, the Midwest fell 3%, and the West fell 1.3%. So the South and the Midwest regions where most of the building is happening are the ones rolling over first. The tightest, most supplied, starved region is the only one still holding up. And this is the general rule with housing. Downturns don't arrive as one national event. They roll over region by region, starting with wherever the most supply was added. By the time the national headline confirms it, the turn happened months ago. The forward-looking numbers back that up. Pending home sales, which means signed contracts that become completed sales in the month or two, fell 5.4% in June. Mortgage applications fell 6.4% in the week ending July 24. Purchase applications down 3.6% and refinancing down 9.9%. Lawrence Yun, chief economist at the National Association of Realtors, has flagged that inventory growth is losing steam. So buyers hoping for more choice may not get that either. When you look at these data points in isolation, none of it fully makes sense. The Fed is likely to hike rates, bond yields at 2007 levels, record house prices, builders discounting into the weakest sentiment in over a decade. They only click into place when you see the pattern running underneath it. Real estate prices move in a rhythm of roughly 18 years. That's about 14 years up and roughly 4 years down, like we've seen for over 200 years. This is based on the framework with data going back, as I said, over 2 centuries. It allowed a man called Fred Harrison to call the 2008 crash years before it arrived. The last major US housing bottom was around 2012. Count 14 years forward from there and you land right around 2026. The final stretch of that boom is a phase where the last buyers pay the highest price with the thinnest deposits at the worst possible moment in the cycle. I think we're either at that stage or very close to it. The Fed's taking credit out of the system and half of its members want to hike, which means more credit out. The buyer of last resort has stopped guiding the market entirely, so lenders are charging a risk premium on top of that. That's more credit out of the system, which consequently increases mortgage rates even more. Every cycle peak in history produced a story explaining why it was different. In 2000, it was the new economy. In 2007, it was the Great Moderation, and in 2026, it's the AI productivity miracle and an engineered soft landing. But it ends in pain more often than not. Now, let me be fair, because I'm not here to sell you the doom. This is not 2008, and I want to be really clear on that. Supply is limited this time, not oversupplied. Existing homeowners are sitting on enormous equity, plus demographic demand is genuinely there. JP Morgan is forecasting home prices roughly flat this year with about 3% growth in 2027, and they expect the Fed to simply sit on its hands for the rest of the year. Zillow thinks mortgage rates ease gradually towards 6.4% by the end of the year. And here's the honest bit of the context on the rate itself. The average 30-year mortgage rate since 1971 is about 7.2%. So 6.7 is expensive against 2021, but it's not historically extreme. However, I could be wrong on the timing here. I'm not your financial advisor. Tops are a process, and this may grind on far longer than the bears want. But I'd rather be prepared and a bit early than caught out completely, especially when it comes to real estate prices. But when you weigh it all up though, the negatives outnumbered the positives. Signal one, the Fed held, but 3 regional presidents voted to hike. That's the most internal disagreement since 2016. The market now put a September hike up to 82%. Signal two, the 30-year Treasuries hit 5.2%. That's the highest since 2007. And mortgage rates have risen 4 weeks straight to 6.76%. Now, signal 3, the builder sentiment at 34 with new home supply at 9.3 months. And the largest builder in the country cutting its full year guidance. 3 independent forces all pushing that same direction. And underneath all of it, consumer confidence fell to 90.8 in July. So here's what to do with this. If you own your home and your payments are comfortable on a fixed rate, you don't need to panic sell. You're in much stronger position than most people are right now. But don't build your plan around refinancing at 5% next year, because the Fed's June projection moved in the opposite direction. Then run one number this week. How many more years do you need to stay put for your current loan to remain the right decision? If you bought in the last 2 years near the top, or you're carrying an adjustable rate, this is the moment to act. Stress test your budget against 7.5%, not at 6 3/4 like today. Open your loan documents, find your rate and your reset date, and put that highest number into a repayment calculator. If the result scares you, build a 3 to 6 month repayments in cash, basically a buffer. If you're sitting on cash, waiting to buy, be patient. You're looking at the market where 37% of builders are cutting prices and 63% are throwing in incentives. That's improving for you every month and will likely continue. But don't catch a falling knife on the first good headline. Buying at the wrong point can cost you years just to break even, especially at the end of the cycle. What you should be doing right now is just going to open homes, talking to builders specifically about buy downs and learning what your local market, the prices are really like in them. And if you're an investor carrying leverage, understand what just changed. The support you were relying on was a dovish Fed who cut interest rates. Those days seem to be over for now, for the short term. There are 3 things you should be watching moving forward. Watch the September meeting, that's around the 15th and 16th, and specifically whether that hike probability holds above 50% going into it. Watch the spread between the 10-year and the 30-year mortgages. If that widens past 2%, lenders are telling you they're mostly scared. And watch builder sentiment, because a print below 34 means people who build the houses have given up on the second half of the year. And the real question sitting under all of this is a simple one. Does inflation cool enough that the Fed can stay on hold and let mortgage rates drift backwards towards 6.4% by Christmas, or does oil keep climbing? Or does September deliver the first hike in years and this housing market sees even more pain? This is all you need to know to now focus on until September. I'll dig into what a September hike would do to the private credit side of housing in a future video. But until then, I'll see you guys at the next video. Take care and peace out.